If you're a business owner, there's a point where the numbers start to matter a lot more than they used to. Not just revenue, but how that revenue turns into profit. Not just profit, but how cash actually moves through the business. And not just what's happening today, but where things are headed next. What I see happening in a lot of businesses is this: they grow to a point where bookkeeping and tax preparation are no longer enough. The decisions get bigger, margin for error gets smaller, but at the same time, they're not quite ready to bring on a full-time CFO. So the question becomes, what sits in between? That's where a part-time or fractional CFO comes in. What I want to do in this video is walk you through what a CFO actually does, what a part-time CFO is, and more importantly, how that role creates real value inside a business. Let's start with the foundation, what a CFO actually is. Chief Financial Officer is responsible for the financial health of a business, but that definition doesn't really capture the full picture. CFO isn't just managing numbers, they're helping guide decisions. I work directly with leadership, the CEO, operations, sales, to make sure the financial side of the business supports where the company is trying to go. That means looking at what's happening today and making sure it aligns with long-term goals. At a high level, the CFO is there to make sure the business is stable, structured properly, and moving in the right direction. And let's make that more practical, because CFO can sound abstract. What does that actually look like inside a business? One of the first areas is performance tracking. CFO is constantly monitoring key metrics, revenue growth, profit margins, and cash flow. But it's not just about reporting those numbers. It's about understanding what they mean. Those numbers tell you what's working, what's slowing down, and where decisions need to be made. From there, the CFO is also managing capital and financial relationships. That includes working with banks, lenders, and sometimes investors, making sure the business has access to capital when it needs it and maintains credibility financially as it grows. Another major responsibility is financial reporting. Income statements, balance sheets, cash flow reports, these all need to be accurate and timely, because if the numbers are off, the decisions that come from them will be off as well. When you move into forecasting and planning, this is where the roles shift from reporting the past to shaping the future. CFO is building budgets, running projections, and thinking through different scenarios. What happens if revenue increases? What happens if it slows down? How does that impact hiring, expenses, or expansion? Alongside all of that, they're coordinating with external advisors, tax professionals, legal teams, auditors, making sure everything is aligned and operating efficiently. So that's the role of a CFO. And let's talk about what a part-time CFO actually is. Part-time CFO performs all of those same functions, but on a flexible basis. Instead of hiring someone full-time, you're bringing in that level of expertise as needed. That could be ongoing support each month, or it could be tied to a specific project or transition. And that flexibility is really what makes this model work. You're not paying for a full-time executive. You're paying for the level of thinking and guidance that your business actually needs at that stage. Now let's get into the part that matters most, how this actually creates value, because this isn't about titles. It's about results. The first benefit is cost efficiency. Full-time CFO comes with a significant cost: salary, benefits, bonuses. Part-time CFO allows you to access that same level of strategic insight without that full-time commitment. You're focusing your investment on high-level decision-making instead of overhead. Another major area is helping businesses reset when things change. Every business hits transition points, whether it's market shifts, internal challenges, or growth that doesn't go exactly as planned. CFO steps in and runs a financial diagnosis. You look at revenue, expenses, and cash flow, and then build out different scenarios: best case, worst case, and what's most likely. From there, they help realign resources toward what's actually working and adjust the strategy moving forward. This becomes especially important when revenue starts to slow down or plateau. When that happens, most businesses don't immediately know why. CFO breaks revenue down into categories by product, service, or customer type, and starts identifying where the real opportunities are. That might mean adjusting pricing, focusing on more profitable segments, or identifying new revenue streams entirely. In a lot of cases, the issue isn't effort, it's clarity. Part-time CFO is also critical during major financial events. If you're raising capital, preparing for a sale, or looking at an acquisition, the financial side of that process becomes much more complex. CFO builds the financial models, prepares the information needed for due diligence, and helps structure those decisions properly. Another area where I see a lot of value is improving financial operations. Many businesses are running systems that are inefficient, whether that's billing, reporting, or expense tracking. CFO evaluates how those processes work and looks for ways to streamline them. That might mean implementing better systems, automating certain tasks, or standardizing reporting so leadership has clearer visibility into the business. One of the biggest shifts, though, is moving from reactive to proactive management. A lot of businesses operate by reacting to what already happened. A CFO changes that by introducing forecasting, rolling projections, and real-time performance tracking. Instead of responding to problems after they show up, you're identifying them early and making adjustments before they escalate. It leads directly into better decision making because at the end of the day, data by itself doesn't solve anything. What matters is how that data is interpreted. CFO takes financial information and turns it into clear, actionable insights, helping leadership make decisions with direction instead of guesswork. And finally, there's the benefit of broader experience. Most part-time CFOs work across multiple businesses and industries. They've seen different challenges, different growth stages, and different solutions. That experience carries over, which means they're not starting from scratch. They're applying patterns and strategies that have already worked in similar situations. When you step back and look at all of this, the role of a CFO has clearly evolved. This is no longer just about managing reports or closing books. It's about helping guide the business. And for many small to mid-sized companies, hiring a full-time CFO doesn't make sense yet. But not having that level of financial leadership at all, that's where problems tend to show up. A part-time CFO fills that gap, brings structure, clarity, and forward-looking strategy into the business without the full-time cost. More importantly, it shifts the way the business operates from reactive to proactive, from uncertain to strategic, and from making decisions based on incomplete information to making decisions based on real data. If you're at a point where your business is growing, but the financial side isn't as clear or structured as it should be, that's usually the right time to start looking at this. You can request a strategy call using the link in the description. Use a short questionnaire to make sure it's a good fit for both sides. And if this gave you a clearer understanding of what a part-time CFO actually does, like the video, share it with someone who's in that same stage of growth, because most businesses don't need more effort. They need better direction.